All right, somebody asked in the comments, where do you determine your intraday entries and exits? With this style of trading, you're actually really just trading the D1. And if you think about it, what you're doing is you're kind of scalping the D1 chart. You're looking for high probability moves on the D1, and all you're using with the 5-minute chart is just to determine that your D1 levels are actually what they say they are. And here's what I mean. So chart reading in TA is pretty contextual. Like you might be somebody who uses anchored VWAPs or SMAs, or somebody who uses HA candles, or somebody who uses volume profile or algo lines, or maybe a combination of everything, which means that there's no way that you're going to be able to get everything perfect. Also, you got to remember that what we're trading is we're trading institutional buying and selling activity. There's more than one institution. So what if you have 3 institutions with slightly different outlooks on the stock and they're all acting together? So it's like layers and layers and layers of all of this TA evidence, right? And that's where things get even more complicated and tricky. If you have like a really messy, choppy chart, it means that there's like a lot of institutions that don't really know what the hell to do with this thing. So let's look at Tesla, for example. Let's say you've marked up the D1 chart the way that you think it should work, which means that when it breaks certain levels, you're like, oh, this is good. Because if this means that the sellers got beaten through this SMA, if this means that the buyers got beaten through this SMA, this means that the sellers are in control and they're going to take me somewhere and I'm going to go for a ride with them. And that's a high probability trade. So how can you tell that you're actually in a high probability situation? Let's zoom in. So you can use things like relative strength, relative weakness, etc. But there's actually going to be moments where you can't rely on relative weakness, relative strength, or even relative volume. You have to rely on price action and these levels. So this is the 50 SMA right through here. Tesla in the morning has relative weakness. Cool. Okay, that's good. Especially on the D1 is what you're looking for as well, because you want that long term to happen, because if shit doesn't go your way, at least you got some wiggle room, you got some cushion. But we're talking about intraday entries. So you're looking for not only for your price to defeat a level that the opposing team has placed, this 50 SMA, but you're looking for your team to turn that level into their level. It's not enough that you break a level, you need to turn that level into your level. Because you might be able to break a level and get totally bounced right back up. That's how price works. It's an inchworm effect. So sellers reach out, buyers step in. Sellers reach out, buyers step in. Inchworm. And if the sellers reach out too far, buyers go, oh damn, that's a pretty good price, I'm gonna grab that. And they might step in really hard and slingshot you back. So it's reach, slingshot back up. So you might get sell, slingshot back up. You need to see that every single time you're reaching out, you are taking the previous levels and turning them into your own. You're flipping them from support to resistance. And that means that the back of the inchworm has to come through with you. The buyers have to concede now that this level belongs to the sellers. So you break through that level, then you come back up and you go, oh, that level was support, it was broken as support, and now I see that that level has turned into resistance. It's not only a weak support, it's actually on your side now. It's an advocate for you. And here you go. So you're looking for confirmation. This also tells you that, hey, the 50 SMA is important. This is a level that mattered. My contextual interpretation of the D1 chart is true because the intraday chart is showing that the price action is reacting to these levels the way that I want. So there's multiple areas that you could enter. The riskiest, most aggressive entry is just right on the break, right through there. Then the next riskiest entry is right at that level. You're assuming that it's flipped, right? So you break a weak level and you go, okay, this level's weak. I'm taking it right away right there. Super risky because you don't know if that level is turned into your favor. The next one is you just take it right at what you're assuming is a level that is on your side, but it's a bit of a leap of faith. Then the next one after that is you go, okay, look at that level right there. Look at that candle. That candle there is a nice little confirmation candle. It breaks this little uptrend, breaks down through there. That's a flat bottom or a flat topped HA candle too, for sure. You can enter through there. Or maybe you need even more. You need the break, and then you want to see this get below where the buyers even tried to pull it back up to their level through there. But every time you enter, you are giving up reward every single time. You're trading risk for reward. High risk, low risk. High reward, low reward. There's a sweet spot as a trader. If you enter on too high of a reward risk ratio, you get messed up. But if you enter on the flip side, you get messed up too. And here is emotionally where most traders are at and why this takes years to get good at. Because you have such a difficult emotional regulation between greed and fear, and you're not acclimated as a trader, because as a trader, you need to have your emotions regulated in a way that doesn't exist in everyday life. You'll either be too greedy or too fearful. And usually what happens is you're super greedy, FOMO, rush in, get your face ripped off, then you're scared for the rest of the day, and you're too fearful, and then you watch every potential trade pass you by. So you're just volatile. You have volatile emotions, and they're just swinging back and forth between losing and losing and losing and losing. Your goal as a trader to be right here. Okay, and I can't tell you where that is, because then otherwise a robot would do that. But that's the inchworm effect. Okay, it's this ratcheting effect. You need to see the level broken, and you need to see the level show you that it's on your team now. Here's one last example. McDonald's. There's a big algo line of McDonald's from these two candles right through here. So if you look on the high volume vision, that's a high volume D1 candle to there. And then it goes all the way through there, and you get an algo break, right? But then you might be wondering, well, how does that not turn into a D1 wick? So look at how McDonald's just inches up, just grind, and then boop, level break right through here. And then test, and it's just not getting pulled back. But look at this, the relative strength is not huge. Like, this thing isn't really grinding or moving that hard, so this might not show up in your scanners. You just have to contextually look at what's going on. McDonald's just broke an algo line. It's supposed to get rejected hard from there. But look at how it kind of slowly crept up to it, got rejected once, and didn't really get thrown back at all. So where the hell are the sellers? Then it broke through, and then it found a bit of support. I'm like, I know the buyers are just a little reluctant. We're not sure yet. And then support, and then support. And then if you enter right here, you got a pretty close place where you can exit. You can exit on a breakdown through here. You could exit on some other D1 level. You could exit on the chart. Oh, sorry, I moved that by accident. You could exit on the chart like at the 8 EMA break, because it was just a compression break. Like, it's pretty close. You enter through here, and then you just sit and wait. You go, okay, well, this level has turned into a buyer's level. It broke through, then it turned into support. And also, when you look at the price action around those lines, it means that your D1 thesis is correct. And then off you go. This is a crazy example. But that's the gist of looking for intraday entries. The 5-minute chart is just there to show you when these important D levels are flipped in your favor, are flipped onto your side. And then that's when you party. The 5-minute chart is not something for you to go, oh, look, it's strong on the 5-minute chart. I got volume. Let's go. You're not a momentum scalper. You're a high probability relative strength trader. So a lot of us are still stuck as like momentum scalpers, where we're just trying to catch like little chunks of moves. But like, the market is not conducive to that type of trading overall right now. It's not high probability. Well, I mean, we had a high probability move yesterday, but that's not how it is. You're looking for a strong D1 chart where the institutions will back you up. So even if you get pulled against, you know that the chart is good and it's going to come back in your favor. You have to think of it like that. So use the 5-minute chart to show you that your D1 lines are what you think they are, and then use it to show you that those D1 lines have flipped from your enemy to your ally.